Portfolio Builder members, welcome to our Thursday trade alert. We made a killing shorting the TLT for a second week. And spoiler alert, we're doing a very similar trade today. Since launching our model portfolio, we've generated $218,000 in profits with a $1.25 million portfolio, or approximately a 17% return. Now our target and promise in our marketing is to deliver a 1% monthly return with extremely low risk. And we've been averaging a little bit higher than that, which is no problem for us. And you can see our only losing month was in July. Other than that, we've been hitting right in our target range, 2.2%, 1.7, 2.7, 1.2, 2.2, 3.2, 2.1, 1.7. And what's cool about our program is we actually have a 99% success rate. That's right. If you've ever done an advisory and didn't get the result that was advertised, this will be a breath of fresh air for you. We launch the trade alerts at a predictable time. We trade the same securities over and over again. And if you go to your email, there's actually a link to go look at every trade alert we've ever posted. So if you're wanting to go audit the returns, go for it. We would love for you to do that. Let's take a look at how we made profit on the current trade alert. So back when the SPY was about $20 cheaper and things were getting nasty from the trade war, we saw the escalations rise and we told our investors to go long stocks, short the bonds. And this was after the TLT had been rocketing straight up all year. And we had been betting up on the TLT all year. So we actually caught the exact reversal in the trend and have racked up some very nice returns. And I believe this trend is going to continue. We'll take a look at the big macro news that helps us guide our trade alerts and how we pick up on the SPY and down on the TLT. Okay, so let's take a look. Here's how you audit these returns for yourself. Step one, we need to look at what the last trading price was of the asset we're trading when we entered into the trade. So this is going back to last Thursday when we sold to open the September 13 144 call. And again, look at the last trading price. This was trading at 144.80. So we sold an in-the-money call option. This is what we call a upside down caller trade. All you're doing is selling a very expensive call option. And you can see we collected a credit of $1.71. We didn't just keep that though, we reinvested it into an in-the-money put. So we bought to open the September 13, 2019 146 put. Now if you do look at our risk chart, it would say your maximum profit per contract was $95, but that's if you were to hold to the close. This does not take into account time premium and option volatility. So in this case, the TLT didn't just go down below 144. This puppy tanked all the way down to that 140 level. And so because of the implied volatility and time premium still left on that put, we walked away with a bigger profit than our calculator actually thought possible. So instead of $95 a contract, we made $160. So let me show you the math so you can learn how to audit these returns and also audit your own returns. So step one, pay attention to that last trading price, 144.80. Okay, and next step, look at what we paid to put on the options. You can see we did a net debit of 22 cents. So we paid 22 cents to essentially own this 146 put. So you can see the call options in the money, it's below 144. So we're agreeing to sell our shares of TLT for a loss, but that's because we're picking up $1.70. So worst case, TLT flew higher. We would still make a profit on that part of the trade. Where we would be hurting is that put option. But that's not what happened. So let's take a look at what did happen. Here's the trade alert to get out today. And so just to review how easy this is, guys, every trade, this is what you're going to do. We're going to own an asset, either the SPY or the TLT or the core assets. SPY is S&P 500, equities product, the best equities product in the world, bar none. Whatever else you own in equities, you might consider selling it and picking up the SPY. It's much more diversified and safe, and has 3 option expirations a week. TLT, unfortunately, only does 1 option expiration a week, so we only trade it once a week on Thursday. Now look at this. We sold to open the 144 call, and we bought to open the 146 put. So here's how you get out of the trade today. You buy to close the call, and you sell to close the put. And you can see we pulled in a credit of 569. Now keep in mind that the TLT did lose value. When we closed this out, it was trading at 140.93. So we made a profit on the option contracts, but we did take a loss on the TLT. So how does that net out? Well, your YouTuber here does all the math for you, so you don't have to hurt your brain. 144.80 was the starting price of the TLT last Thursday when we entered into the trade. Today, as of closing it, it's trading at 140.93. Let me zoom in on this too for you guys. So we lost $3.87 on the TLT security, but that's fine. That's actually what we predicted would happen. What happened to our option caller? Well, we paid 22 cents to enter into that. To close it out today, we were able to collect a credit of 569. So that's a profit of 547 on the option caller. Net, subtract 547 against 387. So we made 547, we lost 387. Your profit is $1.60 a share. In this portfolio, we have 3,700 shares. That's $6,240 of income. And this portfolio is our biggest winner in terms of gross profits to date. Now, again, we do recommend you don't just go all in on the SPY or all in on the TLT. And we've also been recommending a precious metal crypto portfolio, which has actually blown the roof off of these returns. I've continued to add capital to that portfolio. It's showing a 53% return. If I had not quadrupled the position size in that portfolio, it'd be up over 200% today. And again, that represents the smallest part of our portfolio. In December, we went from 2.5%. We had a hawkish Fed. We were only buying Bitcoin at that point. And as the Fed has slowly but surely changed its tone and forecasted what its plans are, we've realized what you need to do, and that is own gold. So we do have a 10% allocation into the precious metals portfolio, which has been performing very well. So that's the summary of what we did from last week to this week. If you want to get today's trade, we don't show it live in the video. You have to actually upgrade and get it in your email account. So if you don't want to miss out on today's trade alert, call Dean 505-322-7515. He's an expert trader. Not only does he follow our trades, he also takes the ideas and makes substantially larger gains. He is very advanced at what we're doing and can answer all of your questions. So feel free, call Dean 505-322-7515. Let's not let you miss today's trade or tomorrow's. There's some big news happening right now, and I really don't want you to miss out. Okay, so let's take a look again we'll just see if we have any live chats in there. We've got 5 people watching right now. I do want to remind you that we have a live webinar coming up shortly. So we did issue this trade alert a little earlier so that we can prepare for our live webinar. Now, all of you who are on the email list, you're going to get an email in about, I'm thinking 30 minutes from Zoom that will have access links to our live webinar. This is where we can spend at least an hour, maybe 2 hours, teaching you exactly how our system works, what the schedule looks like, what our returns have been, and what we're expecting to do in the future. So again, don't miss our live webinar coming up in about an hour and 20 minutes. You'll have a link to it in your email, and if you don't have access to that, and we just had 3 more people join, welcome. You can always scroll back on the video because this is a live stream and catch the opening. I just reviewed how we had a very healthy profit on the TLT, showed you how to audit the return so you can see exactly how you can keep track of our results or your results and not just trust our content. Okay, so let's take a quick look at the big news and then we'll let you guys go so you can get ready for our webinar coming up again in an hour and 20 minutes. All right, so the biggest news was that at the request of Vice Premier of China, Liu He, and due to the fact that the People's Republic of China will be celebrating their 70th anniversary on October 1st, we have agreed as a gesture of goodwill to move the increased tariffs on $250 billion worth of goods from October 1st to the 15th. I saw that tweet after getting back from my son's curriculum night, and of course, if you've been following our daily video, I've been predicting this is exactly what would happen. China would most likely buy some farming goods, and Trump would probably just kick the can down the road, put a little bit of a truce flag up, and equities would rally really hard. I didn't think it was going to happen this fast, but we were positioned exactly for this to occur. So our SPY trade is up significantly. It's at maximum profit right now for tomorrow. Our TLT trade is at maximum profit. So this is all playing out. Now, I texted Dean this and asked him if he had been long yet. And of course, he was watching the Newswire and jumped on it, made a huge return overnight. And so everything's playing out just how we expect, although the risks are still out there. We'll talk about the risks. I'm thinking that the Chinese have about a 50% chance of actually not buying any farming goods because, once again, what we're asking them to do is actually give up all of their competitive advantages with their political structure and the size of their 1.4 billion citizens. For now, the coast is clear and we have some easy sailing and pretty dead obvious profits. Here's some notes out of China. We welcome this decision. It should be seen as a goodwill gesture the U.S. side made for creating good vibes for the trade talks scheduled in early October. Yesterday, China announced to remove 16 categories of U.S. products from the tariff list. Hope reciprocity of goodwill can continue. Chinese Premier Li, I don't know how to pronounce that one. China is the largest developing country of the world, and the U.S. is the largest developed country. We share wide common interests and believe we have had the wisdom to find a solution acceptable to both. Now, you got to remember, they've been telling us they're going to buy goods for 2 years now, and all they've done is cut back. And this is in the face of massive inflation in food prices. At the same time, their manufacturing products are having deflation. It's a complete nightmare for China right now. But if what we're forcing on them really came true, it would completely obliterate all these competitive advantages they've had that have allowed them to sit on 6% plus GDP for 30 years without a recession. So this may be all coming to an end with a dramatic crash if Trump continues to push the buttons. Okay, Trump just pushed out a neocon warmonger. Rami complained. Paul praises Trump. This is a good thing for U.S. This is about Jack Bolton getting terminated. This is still something I'm curious about, how quiet the media has been. Jeffrey Epstein's supposed suicide. Supposedly this great trader, but no one has ever heard of him. He supposedly had a huge amount of wealth collected, did deals with interactions with Bill Gates, now just came out. And so what exactly is going on with Jeffrey Epstein? Something I'm just keeping track of. No conspiracy I want to float yet on that one. From Bloomberg, a collective sigh of relief was heard around the world when President Donald Trump decided to delay the imposition of 5% extra tariffs on Chinese goods by 2 weeks. So you got to laugh. This is only a delay of 5% tariffs for 2 weeks. So clearly the risks are not removed at all yet. The big thing I'm watching for is real purchases of agricultural goods. I do think that would be enough to get Trump to delay the December tariffs, perhaps indefinitely, and put some less pressure on Huawei in return, maybe even return their CFO, the daughter. On the other hand, they are going to have to purchase a ton of farming goods. If that happens, maybe they leave it at that for a while and say they're continuing the talks, and Trump will pretty much have a free ride into the election period. Now, if they don't buy farming goods, look out below. We probably have a huge rally in bonds and gold ahead, and another crash in stocks as they start to re-escalate. So hard to predict what will happen of that. The Chinese love to use trickery as almost part of their culture. If you're not taking advantage of the other person as much as possible, they think you're weak, a weak negotiator, a weak person in general. So we'll see. They do need the food badly. That's the one reason why I think it could make China look strong, is to come in there and solve this food problem and give themselves a little bit of a breather. But on the other hand, the 7 deadly sins that they do, that we're trying to put into law, would really cripple their ability to outperform the rest of the world and take advantage of the rest of the world, where they're just ripping off everything everyone does, keeping their economy closed, subsidizing key industries, and manipulating their currency. The list goes on. Meanwhile, the CPI print, the inflation reading that the Fed uses to determine if they can keep rates low, is starting to heat up. So we're seeing inflation in China, and is it going to start to ripple into the rest of the world? That's what will really end this whole bull market party for equities and for bonds. So keeping a close eye on that, although the Fed has said they will keep it running hot for a considerable amount of time. We now have some new people watching. Welcome. Feel free to zoom back or drag that little cursor back to the beginning of the video so you can see the audit of how we pulled $160 a contract on the TLT and how we've hit max profit on our SPY trade alert from yesterday. So continuing on. We do have our webinar coming up in an hour, so I'm keeping today's video a little shorter. ECB came out today, and some more from the ministry. So they're hinting that they'll buy up farming goods. We'll see if that really happens. Hipster trader markets are now less than 0.5% from the highest level ever, and we need rate cuts, QE, and tax cuts despite the economy supposedly being the best ever. So we have the Fed coming out next week. My expectation is a small rate cut, nothing big, and probably not even talk about QE yet. Okay, Trump, it's expected China will be buying large amounts of agricultural products. That's not the first time he's tweeted that. The cost of pork, which is their favorite meat in China, has doubled year over year, and just in the last several months has been inflating at a pretty dramatic price. Now, supposedly they knew this escalation was going to happen and had a huge amount of pork frozen to be able to make it through, a cold winter of such. So we'll see. But meanwhile, the prices continue to skyrocket. Northman Trader, I like to listen to. He's got a good YouTube channel. Draghi, negative rates have been quite a positive in stimulating growth. And he says garbage. So they have a -5 interest rate after their latest drop and are starting up the next round of QE. In fact, here we have Trump talking about it. And this antagonism between Trump and the Fed and Trump and the media has me concerned, very concerned, because if they really want him out of office, the easiest way to do that would be to try to orchestrate some sort of stock market crash and put the economy into a tailspin. So I watched it from that point of view. European Central Bank acting quickly, cuts rates 10 basis points. Plus they started up 40 billion, or rather 20 billion a month in euros in terms of bond purchases. ECB's Draghi says need for highly accommodative stance, says stand ready to adjust all instruments, says incoming data since July meeting indicates more protracted weakness, says persistence of downside risks. Now what we'll see is the banks in Europe did not like this news today. They are selling off. Draghi goes all out, ECB cuts rates, restarts open-ended QE, changes forward guidance, eases TLTRO, and introduces tiering. So basically they're talking about buying up these German bonds as well. We'll take a look at that in a minute. Here's the dollar chart. As long as this dollar is strong, I believe we're going to see the rest of the world suffer and find their way to U.S. products, from the dollar to the bond to the equities market. And so That's really one of the most important charts to look at. Also, the Chinese to U.S. conversion rate. Germany continuing to lower their forecast of GDP, almost down to 0 now. Draghi has launched Shadow MMT. There was actually a really good Macro Voice interview with a rates expert, specifically in European rates, and she pretty much nailed it in predicting what would happen here. Definitely a good YouTube channel to subscribe to. But tells government Germany all excess debt issuance, fiscal stimulus, will be monetized by the ECB. So instead of just printing the money and loaning it out to the banks, now they're talking about picking up the government debt as a way to funnel money through a different means into the economy. Gold surges after Draghi unveils easing. Again, we're long gold. China seeks to narrow trade talks with U.S. and bid to break deadlock. We'll see what comes of it. For now, we have a free hall pass to follow the trend, which is essentially that there's nowhere to invest except the U.S. So without tensions rising, the bubble up effect is going to continue. Here's the CPI print, a little hotter than expected. Again, they're saying they're going to run inflation hot to make up for all the years with low inflation. Here's what we're all afraid of: China becoming a bigger military power than America, as they're on track to dramatically have a larger GDP than the U.S. within the next 10 to 20 years, if things remain the same. Now, I think they are going to have a huge setback if the administration's plans continue to be pressed onto China, which I think they will. ECB cuts 2019-20 GDP forecast, lowers it down. Kyle Bass, banks in Hong Kong are showing signs of panic, need for deposits. The money is running. Deposit rate offers China merchants 5% for 1 month. HSBC, 4%. We have seen 3 medium-sized banks in China collapse now. Will there be more? U.S. core inflation exceeds forecasts as medical care costs jump. Here's the top tickers we watch. Everything's in the green today. Even the Russell 2000 is looking very strong right now. Here's that SPY chart. I think the SPY can travel to 315 to 330 without any major aggravation and just a 25 basis point cut next week from the Fed. Give us that. I think the SPY is going to rally a lot higher than people suspect, and then I suspect that Trump will re-escalate the China trade war because the Chinese do not buy any farming goods. Now, China does buy farming goods. I really like being long emerging markets. Let me find that chart really fast. So it's hard to really gauge how much pain China is in right now and whether they're at a breaking point yet. If they are, and essentially give in and start buying massive food, this emerging market ETF could easily run up 20% to get back to that $50 price point. So I might play that in our Tuesday play if we get a farm deal. If not, look out below on emerging markets, stocks in general, and our TLT and GDX will save the day. Okay, so let's go look at the rest of the charts. TLT's having a sell-off. We're short the TLT one or two more weeks. I think this rally in equities has some more legs on it, and this will continue to put pressure on the TLT. At the same time, I think the Fed will disappoint the bond market next week by only cutting up to 25 basis points, maybe even a little less. So we'll see. Now, on the other hand, if the Fed comes out super dovish, we may have a losing week on the TLT, but our losses are controlled. The most we could lose week over week on our current TLT trade is $1 a share. Okay, LQD having a sell-off. This is really what I'm looking at. If this were to massively crash, that would mean the companies like Microsoft, Apple suddenly have a hard time getting the bond market to loan them cash, which they're primarily using for corporate buybacks. So it's still very healthy and at a very high level, which means low interest rates for investment grade debt. The Russell 2000 is having a hell of a rally, and this is what Stanley Druckenmiller uses to gauge the overall health of the stock market. If this really were to get towards that 173 level and stay up there, that could indicate we have a whole nother long-term bull market in equities ahead, because now the bottom 2,000 companies are doing well, not just those top companies that hog all the profits and credit and buy back their own stocks. Tuesday play is currently long Facebook. We got a nice jump today on that. I'm expecting it can run towards its highs in the near future. Of course, we're looking to get out of Facebook in our Tuesday play in the near future and either go with Microsoft or emerging markets, depending on the news developments, and then eventually get into the silver ETF, as we will expect trade war escalation. So if this farming deal doesn't come to fruition in the next few weeks, we may look at rotating into silver ETF for the Tuesday play. GDX had a little sell-off. We expected that, said to remain long because of what the central banks are doing. So ECB did not disappoint. Maybe they weren't as dovish as they could have been, but that's still pretty dovish. $20 billion a month of bond purchases will put a lot of pressure off the bond market, push it into all these other markets. GDX, again, looking at the big picture, the last time we had a big monetary stimulus, it was from 2008 to 2010, and that drove up GDX all the way to 66. Well, guess what? The amount of debt that we have to service through printing money has something like quadrupled around the world over the last decade. It's absolutely insane. So 66 is just the first mile marker for GDX, in my opinion, and it could go dramatically higher if the trade war does continue and all the central banks start to print up money. EEM we looked at. Here's a surprise, kind of. The European-related securities we follow are all down today. They are suffering from low interest rates from their central bank, or negative interest rates, and continue to do so. A lot of people say if Deutsche Bank were to go below 6, it could become insolvent. That could be a huge financial systematic risk to the banking system. So we're keeping a close eye on that. So far, no problem. Here's Deutsche Bank chart. HSBC was rumored to be essentially managing the currency exchange rate of the Chinese renminbi, and there's been a lot of drama about that. Apparently, they were using future contracts to short the dollar to try to stabilize the currency, and that backfired on them. Dollar's gone stronger. Their currency has devalued dramatically, and that created huge losses. So this futures bet on the dollar or against the dollar by the Chinese could be what actually broke their back. Hard to say because they're so secretive. But despite having supposedly good profits reporting out of HSBC, they have fired literally half of the upper management, including the CEO. Lots of rumors going around this bank. You can see some big selling and buying, of course, at these sell-off levels. So two banks we're keeping a close eye on. The most important conversion rate in the world right now is to simply watch the CNH, the offshore Chinese currency, against the dollar. Every time this puppy starts to spike up, within hours we see stock market volatility. We see nasty comments either from China or Trump, and then we get a big bid on bonds and gold. So this is by far the best leading indicator for predicting stock volatility. Right now you can see it selling off dramatically, indicating we have a period of peace ahead. Another look at that. Euro weakening, again pushing the dollar stronger. Crude oil, I love it in this range for our current setup. If oil were to go too cheap, I'd probably start betting down on stocks. If it gets too expensive, then we have a bigger problem because now we have inflation. The central banks are going to have to raise rates. Now you get a double whammy. You get your stocks and your bonds crashing. simultaneously with the current macro environment. Gold sitting up above 1,500. I doubt it will go below 1,500 as the central banks in China and Russia are loading up on this, plus all other central banks whose currencies are losing credibility from devaluation of their currency, which is happening worldwide. All of the emerging markets are lowering rates, buying up their own debt, trying to get out of their US dollar denominated debt, which is causing them a lot of pain. Silver, again, we love to pop back into this, but I think we still have a little more rally ahead and maybe a little more pressure on silver. It's hard to call a bottom on gold or silver right now because we have, on one hand, a de-escalation in the trade war with equities rallying. On the other hand, we have all the central banks still reacting slowly and lowering rates and printing up money. So I think we'll ride Facebook for a little while, switch to Microsoft or emerging markets, and then once it gets nose bleeding high and no farm deal is being made, start to see some impatience out of Trump, and then we'll hop back into silver for our Tuesday play. German bond yield has been a good leading indicator for the TLT, and you can see how well they line up. I've got a few videos for you to watch. Secretary Treasury had a good interview, about 20 minutes, talking about the trade war. And then we had Peter Navarro. So those are two links. Again, you can get access to this in the email. And that's a wrap for today's video. Call Dean 505-322-7515. Let's make your life easy. Consolidate your portfolio into 3 ETFs, the SPY, the TLT, GDX. You'll be set for life. Okay, guys, we got a webinar coming up in an hour. Please make it. We'd love to meet you. In this one, you can talk live with us, meet other members. We've invited our paid group in today, too, so you can actually meet some people who have been following the trade alerts. And that's a wrap. We'll see you in 1 hour.